Okay, covering a stock that is not a B. Riley related business for a change. This is National CineMedia, NCMI. This company recently emerged from bankruptcy in, I want to say, August of this year, and looks really interesting. I actually didn't notice it until they announced this $100 million buyback, which is 20% of the now slightly higher share price. So just take a quick look. This was a $3 stock coming out of bankruptcy, moved up to four, and then just overnight spiked from 420 to $5. So um, I think it's interesting for a couple of reasons. First, what they do. This is the little like pre-movie that you see when you go to a movie. The 20 or 30 minutes that you're waiting for things to start, and you see the whatever advertisements and commercials and clips that they run. NCMI puts all that together. They take in advertising revenue and then they share some of that with the movie theaters. So AMC, Regal, and Cinemark are customers, so to speak. And they've got exclusive contracts in all those theaters. So they're in like 18,000 theaters or something like that. So COVID impacted business, right? And that's why they went into bankruptcy. So here's the revenue. Here's the OIBDA, the media version of EBITDA, and went negative in 2020, 2021, rebounded, but not enough to service the massive pile of debt they had. So they came out of bankruptcy and cleared all of the debt, right? So let's see if we can find a quick balance sheet. Here it is. So here's the debt, right? 10 million now as of December 2023 was 1.12 billion December of last year. They got some cash, so really this is a net cash balance sheet of call it $27 million. The new share count's about 97 million shares. Here, let's see if we can find the slides. Okay, here it is. Here's the old structure. Used to be owned by Cinemark, Regal, and AMC. They're now not involved in the entity. Lenders took control. 97 million shares. So what do we got? We've got 506 share price times 97 million. We got a 491 million market cap. Net cash we said was 27 million, so 464 million enterprise value. Yeah, so it looks like they pulled in a little bit of cash in the last quarter. And we'll come back to the full year results. So full year results. There's our balance sheet, and we should have a. Here it is. So here was our full year EBITDA number was 52.7 million. Now that was down from 2022, which is interesting because the box office numbers were still recovering. Attendance, just overall box office was up, but still it's still sits at 30% below where it was in 2019. So kind of an interesting potential recovery there. So 52 million, we'll call it 53 million in EBITDA. So this is basically trading at right around 9x, right? 9x with a net cash balance sheet. Now, 2023 was a messy year because of bankruptcy, but historically, this is a high cash converting business. There's really not a lot of capex because it's advertising driven. So, what do they comment on that? 80%. Here we go. Strong balance sheet, position to generate significant free cash flow due to low capex, really no debt, and cash conversion from EBITDA to free cash at 80%, right? So 52.7, 80% of that's 42 million in free cash on 97 million shares. You're talking about 43 cents a share in potential free cash, or just under 12x price to free cash flow with no debt, right? And a potentially $100 million share buyback coming over the next few years. So you know that you're going to have likely some per share growth in there. And on top of that, you get this kind of a play on I don't know that I have a really strong opinion on box office in general, but I don't know if it's going to go back to what it was in 2015 to 2019 period, but if it slowly creeps up that way over a multitude of years, then you get a benefit from that in what's a really clean balance sheet and a really decent business model. Now, there's a risk to that, right? I mean, they're beholden to only a few movie theater chains, but what was interesting in their 10K, they did say, or what was it? They had a whole section on Regal because Regal filed for bankruptcy too. And Regal went into bankruptcy and said, "Hey, we want to cancel this, 30-year contract they had with NCMI," and they did. But then they came back and they renegotiated a 10-year deal. So it's like they still came back to them after the fact, uh, and they went through some legal. Here we go. They went through some legal stuff. Yeah, in September 2022, their parent company filed for bankruptcy, rejected the contract that they had. Blah 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 blah. Then in July of 2023, so a couple months later, they signed another 10-year agreement. So even if you think AMC or another movie theater chain could go into bankruptcy, they may still wind up wanting to use this provider for the services that they're doing. So anyway, kind of an interesting business. What I don't know a whole lot about is why results were down just in the latest quarter. I think movies can be kind of a seasonal business, just quarter to quarter, depending on releases. So I don't know if there's a whole lot to read into. Only 7 slides. I don't know that there's a whole lot to read into 2023 results versus 2022, but someone more educated on the business or the industry might have an opinion on that. So um, let's see, what else did they say? The 100 million buyback. There was a really good question about that. Let's see. Here we go. This guy. So he wanted to ask about the buyback and said, "Hey, came out of bankruptcy. You were really happy that you had this flush balance sheet. Yeah, no debt, some cash, and now you're coming up with the share buyback, 100 million bucks, which would, if they spent it all, would put them solidly into net debt territory." So, oh yeah, and they commented, "Hey, 2023 was probably about 23 million in unlevered free cash, right? Because of the bankruptcy situation and some other things." So he's like, "Walk me through what you're thinking here." And they started to go through the details. Well, first he said, "Hey, look, we've analyzed this. We're really comfortable with the cash flow and the projection and blah, blah, blah." So I think they see how the business is performing on a monthly basis, knowing like once we wade through this bankruptcy stuff, then it should be pretty good. But then let's see the other comment that was made. It's a 3-year program. So that's now through 2027, first quarter 2027. So they'll get all of 24, all of 25, and all of 26 cash generated. So, and they're looking at it saying, "Hey, if there's a recovery in the business more than that 100 million, then it should cover the entire repurchase program," right? So that's kind of interesting. Basically saying, "Hey, over the next 3 years, we'll probably generate $100 million in free cash." Um, and then if you look at 2020 or the 20 million free cash that he commented on, doesn't seem to be enough. But we do believe that over the next 3 years, the business will get back to a level where the box office is recovering more fully. So they're kind of saying, "Hey, the model's predicated on some recovery there, which would get them back, right?" So, if you took that 52 million of OIBDA, they say 80% conversion, right? Well, let's see if it gets to 75, 60 million, right? So anyway, we're playing with numbers at this point. So yeah, I don't know. I did look up the bankruptcy filing, and they always have a financial projection section of the bankruptcy docs, right? Financial projections. So they have to come up with a value for the company and say, what's the next few years going to look like? What's your plan? And these are sometimes just, pie in the sky things too, like straight line linear growth scenarios. And this is no different, right? So here are the projections that were filed for this, bankruptcy document, right? So here's the OIBDA number for 2024. They thought it would be 56.5, so it came in light. And they come down to a net income number. There's a ton of intangible amortization. So the again, that just leads to the higher EBITDA to cash conversion figure. But this document is just like a straight line linear growth from 56 million in EBITDA up to 82.5. So I don't know how reliable that is, but if you said it was worth 8.5x at that point in time, what do you 100 million? Let's say you buy it back at, I don't know, pick a number, 15 million shares. Is that too aggressive? So 80, what do we get to? 97 minus 15, so we're at 82 million shares times 8.5. Right, we'll just say that net debt zero. I don't know. Let's just say they spend it all. So you got an $8.5 stock in a couple of years. But again, this is just like anyone could do linear increases in revenue and earnings. So I don't know. A lot of it might be predicated on this. But what I like is you're buying it off of these numbers as opposed to buying it off of these numbers. So if you're saying, hey, I'm paying a fair price and have a good balance sheet and a buyback plan, and you're here, that's way more interesting than all of those things up here, where you're really beholden to what box office situation looks like in the next few years. So um, I don't know. It's kind of an interesting setup. It's not like insanely cheap, but man, it has a rock solid balance sheet, and you're gonna have some support. 100 million bucks on, let's see, 506 97, so 140. Yeah, so a little over 20% share buyback over the next couple of years. And I don't know, maybe they can lever up to in small chunks to take down blocks at a time. So kind of an interesting story. Just a really quick look, quick take at it, but I'd love to hear some thoughts on it. Looks like an interesting one.